Volatility is the buzzword. We can't get away from it over the last couple weeks. How does this play through from your perspective, and what does it mean for investors?
Okay. I think basically our view at KKR is that we've entered a different investment regime. So 2011 to 2015 and early 16, China was slowing. You wanted to get long duration, stay in the U.S. Today, we think that we're at the cusp of interest rates bottoming, starting to move up, not in a wildly aggressive way, but clearly there's a signal from the Fed that they need to do more. We're adding stimulus to the U.S. economy at a time when unemployment is at 4%. So typically, you're actually narrowing your deficit at that point. Today, we're actually increasing the deficit. And I think investors are taking notice of that. So some of what happened the last week was related to me, just volatility funds. People had been overly aggressive. But I think there's more of a regime change going on. Really, this change from monetary stimulus to fiscal stimulus. And that starting with the U.S., but ultimately we think that will be something that transcends and goes global.
So we were talking with Steve Schwartzman earlier this morning, as you know, and he said this level of volatility feels pretty normal. Do you agree, or is this an aberration of any sort?
I agree that as you get later cycle, you have more volatility in the equity market. I think what's changing is that you're losing the cover of the Federal Reserve around interest rates. So that is new. We've had the Fed kind of, protecting us for quite some time, and they're clearly now the lead horse changing interest rate policy. We haven't seen that in Europe. We're hearing hints of that, and in Japan, we have the opposite, where they're still very accommodative. So I guess where I would have a slight difference is, to me, there is a shift in monetary policy, and that's probably going to lead to more volatility. Certainly, and we're seeing it in interest rates right now, not necessarily in credit, and that probably makes sense given that this is more about changing the risk-free rate than the conditions of corporates around the world. In fact, a lower tax rate in the U.S. probably makes the corporate profit stronger this year.
Well, and let's talk about credit for a second, because it's a theme that you've really been writing about pretty consistently for more than a few quarters now, really a few years. It does feel like there's a fundamental shift maybe in the appetite for credit, especially in private credit. Where are we now in that?
I think generally we would argue that investment grade credit is quite expensive. I mean, we traffic more in, I would say, the more complex areas, so high yield and then into the private credit. Globally around the world, what we see, and I was just in India, we see a real growth in Asia in this private credit. Corporates want access to capital quickly. These transactions are complex, and they typically will partner with a firm like KKR that can help them. Generally, this started, though, after the financial crisis in the U.S. when the banking system contracted. And if you think about the assets in the U.S. banking system, we took the equivalent of 5 Morgan Stanleys out of the system. So folks had to step in and provide capital. That's become a more mature business today. We see growth in the U.S. We see growth in Europe. But I'd say we're spending more time today in Asia, where we see some pretty interesting opportunities, both in the emerging market side as well as, we participate in areas such as Australia and other developed markets where there's some interesting things as well.
And a big theme in your report, as you alluded to, was what's going on in India and in China. China seems to be at a rather fascinating moment right now, whether it's the broad economic story or even the more specific stories of some what appear to be forced sales of real estate assets. How does that play through the market, do you think?
So I think we have somewhat of a differentiated view. Our view is that China actually crashed from 2011 to 2015. So a lot of people are hand-wringing, is China going to fall apart? We have lots of businesses in China, and what you saw from 11 to 15 was essentially nominal GDP went from 20% to 6%, just a massive. Today it's rebounded to about 12. That's actually a pretty good environment for growth. Whether you do business in China or not directly, you need to know about China. It's a third of global growth. When you include its immediate trading partners, it's about 75% of growth. So we're obviously pretty focused on that. We're quite active. We've been active helping Chinese companies go abroad, but also, I'd say more recently focused on technology within China and just a move towards consumer experiences. There's just a huge growth in the middle class, and that's been pretty interesting for investment opportunities.
And you feel like that's going to continue, that there will still be things to buy there in China?
I think it's a little bit, when you think about China, you think a little bit about having a fire extinguisher and then gasoline and putting it on the fire. So yeah, it's hard to have a very stable policy. Right now, they're trying to urbanize their economy. economy. They clearly know that they had too much credit growth. So right now they're really tightening up the financial conditions. But there are other things they are doing around just, I would say, urbanization and increasing the rural population's GDP per capita that are actually leading to some pretty positive things. And the last point I would make is they are clearly focused on, as the U.S. moves towards more of a America First policy, China is very focused on kind of consolidating power in the region.
Interesting.
Yeah.
Closer to home here in the United States,
Yep.
energy is something you've paid a lot of attention to, and that feathers into almost everything, including real estate. How does that play out in the near term?
So we raised our weighting in energy this year, and our view was, one, commodity prices bottomed. It's also a reflection of our view on the dollar, that we think the dollar has peaked. But more importantly, from a micro standpoint, I think if you talk to our energy team, what we're seeing is there's now a meeting between the buyers and the sellers. A lot of the public companies want to show growth in the Permian basins, so they're selling off some of their maybe less productive assets to fuel that growth, and that's been good for us. And then one thing I think you guys have reported on, I mean, the MLPs have been hit very hard, the master limited partnerships. That's an area that we've been invested both in our infrastructure fund, but also in our energy income fund.
So briefly, before we let you go, I mean, what's the mood of the institutional investors that you're talking to right now? Are they confident? Are they worried? If you can generalize.
It's a little bit of a double-edged sword. A lot of people have had a lot of capital returned to them because markets have gone up, particularly on the equity and the high yield side. But I think they're cautious about valuations. I think we share some of that conservatism. I'd say the most bullish thing in the market today is that, like the late 1990s, there's some pretty major bifurcations where we're seeing things that are priced for perfection look incredibly expensive, largely around growth stocks. But on the other side, things around commodities, some of the complex situations we talked about in real estate and energy, even in financial services, they're priced at very interesting discounts. And that's true in the U.S., Europe, and I would say as a firm, last year was our first year in 41 years that we deployed more capital in Asia than the U.S., so that's probably worth noting.